There you go. Hi, everyone. We're here today with Rob Massey, and Rob is a partner with Deloitte. He's a global leader with the blockchain and crypto group, and he's going to talk to us today about more about digital currency. I know we're seeing a lot more tax returns with clients that have this type of situation. So I'm going to turn it over to Rob, who is an expert in the field. Hi, Rob. How are you today?
Thanks for having me, Minnie. Expert, yes, as much as you can be in this field. So I started serving in this space, that being blockchain digital assets, just over 10 years ago. So I was very early, and it still feels early as we don't have a ton of rules on point. It was a little bit of guidance, which we'll get into. So as the adoption of digital assets grows among all segments, including our client base, we're left without a lot of rules. And so it's important for us to dialogue, what do we do when clients show up and need our help? So what we thought we would do today is first to cover a little disclaimer, right? Our tax aid. And so this is not giving a lot of formal tax advice, but just be wary and consult when you have questions in this area. Important to note, we are really proud of TaxAid and all that we have done in our long history. But one of the things I'm most proud about is that we are flexible in accommodating people in lots of different situations, including those who have digital assets and want to report those. I think that some organizations would not feel comfortable reporting those transactions. We try and help everybody regardless of their situation, which includes crypto. So I'm really happy about that. Okay, in terms of the agenda that we're going to cover today, so you can see what's coming, what are digital assets? Just for a minute, just to level set with everybody, we'll go through some tax implications. What are some documents you might receive from clients? What do they mean? How to deal with Lacert? What does basis tracking mean in this space? And how to claim losses if anybody has that situation. And then who to call for questions. The first thing I want to talk about is what do we mean by the digital asset ecosystem? And so what's different today what's different today around blockchain digital assets is that the protocols in which the digital assets relate are decentralized, most of them. What do I mean by that? Software in the past is controlled by an organization. And when you have a problem, you have a question, there's a helpline, there's a name, there's an address, there is a group that controls the code. In decentralized ledger applications, those which house crypto, DLT, distributed ledger technology, there is not one organization which controls the code, and that's different. And this is why it's hard. And each protocol has digital assets that are native to that protocol. The Bitcoin protocol, I keep this because it's the cloud on your screen. The Bitcoin protocol has Bitcoin as native currency. The Ethereum protocol has ETH. The Solana protocol has Sol. And so it's important for us to differentiate the technology from the assets, noting that all digital assets are not created equal. And we'll get into some examples of those. Why am I explaining this? The ecosystem is evolving around these decentralized protocols, some with normal parties that you would expect. Our clients, some of which use digital assets as a means of exchange or to invest in them. Most of them don't have the technological wherewithal to code directly on the protocol or secure those assets. They have that opportunity. Notice what's different about today's world is that the users can relate directly to the protocols without the need for an intermediary. Many would argue, like myself, I'm not a technologist. I need to go to another party like a centralized exchange, we'd say CeFi, or TradFi, even banks getting into this to access the digital assets, which then come into play in the protocols. And so the parties involved frequently will indicate what is they'll indicate the transaction types that are relevant to, and the tax analysis relevant to the transaction. The other thing of note is that protocols don't work because of magic beans. They work because there's real humans and machines behind that. We would refer to those as nodes or validators. And the actions sometimes of our clients, if they're mining As an example, they're acting to validate transactions that would produce rewards. If they're validating through a staking protocol, that would produce rewards. So some examples of how these parties relate. A little bit about the ecosystem. Now, not all crypto is created equal. So there's this classic question that I've used called, what's the thing? And that is because we have different strata of digital assets. So traditional crypto, Bitcoin and ETH being the two most popular, those built on decentralized ledgers, those used primarily as a store of value or a means of exchange. Stable coins have come into favor because people don't want to deal with the volatility of crypto, but they want that programmability feature and they want the ease of moving between parties. And so but not all stable coins are created equal. Some are dollar backed and secure. Others are driven by algorithms, and some are general asset backed. So stable coins have different flavors. With the tax lens, what does that mean? If we have crypto or stable coins or anything else on this list, you have to say, what's the thing with the tax lens? The IRS will tell us on occasion it's a general property. Well, okay, but it could also be a debt instrument, which would translate to security under some definitions of the code. It could translate to equity if it's a governance token, right? This next line down has tokens of different kinds. And if that governance token has elements of equity, then it can feel like equity, and maybe our clients would be on the hook for reporting certain other transactions or inclusion events. So you really have to study what is behind the scenes. Now, most of our clients are not going to get into this complicated state, but you never know. And we should arm ourselves with the questions. If it comes up, let's consult, and I can help with that. So tokens of different flavors, utility tokens still coming around. We have asset-backed tokens, so tokenized gold and palladium, etc. Governance tokens, which would give you rights to a DAO or treasury, and importantly now NFTs. That's really what's happening a lot today. Digitized securities in different flavors, and now central bank digital currencies, which do exist in parts of the world, and more belief that those will be online in the US and in the near term. So China and Russia have those enabled. It's with discussion in the US, but we always have to pause, and before we report the transactions, ask ourselves the question, what's the thing? What guidance have we had to date? Not a lot. In 2014, we had our first notice, which says, as I noted, it's property. So the question, what kind of property is it? And that's why you go to what's the thing. The notice also said, hey, if you're engaged in mining activities, those rewards are income to you upon receipt. It said, if you're using crypto as a form of payment to an employee, don't forget to withhold payroll tax. And by the way, we, the federal government, don't take crypto as a form of payment. And so you need to send us fiat. So that gets very tricky. Probably not for our clients, but you never know. There was a Rev ruling in 2019 that came about and described that property received in a fork is income. So there was a little more to it than that, but that was the punchline. And at the same time that the revenue ruling was put forth, the IRS listed a number of FAQs on the IRS website. So not a lot of authoritative guidance, but it is instructive. They update the FAQs without notice. And some of what we think about in terms of basis tracking is informed by these FAQs. So just know that that is a resource to you, and there's a link provided at the end of this deck. Obviously not huge amount of authoritative guidance, but it is instructive. There have been some CCAs on some minor topics, and importantly, the Infrastructure Act passed in the fall of 2021. I get my year right there. And that was the first time that digital asset was defined in the Internal Revenue Code. The way that they defined it was very broad, all digital assets of different flavors, including those I mentioned on the other slide. It was enacted on Code Section 6045, which is around informational reporting. This is those who facilitate transfers of digital assets between parties, and we'll get into what that means from a 1099 perspective. While this was enacted in 2021, it is not yet effective, and the IRS has now pushed out the effective date, meaning we still don't have consistency in the 1099s received by our clients, which causes some of the anxiety. That's why I want to flag that. There's other things coming. There's executive orders that have come around from the White House. There's more to come in terms of a roadmap. We'll see what that says. The Green Book referenced crypto lending. That did not take shape, but just know that it's there. We expect Treasury regulations on the 6045 rules, and then other proposed legislation like de minimis type exceptions, which we've not yet seen. So that's a quick spin through legislation. Okay, when do you need to report for our clients? First of all, you do not need to report. Let me get through all these things here. Okay, you do not need to report, importantly, if our clients are purchasing crypto, if they're holding it. You guys know hodling, right? Holding on for dear life is the acronym. It's kind of a joke. You can look it up. So if they're hodling, you don't need to report. Transferring from one wallet to the next, it's fine. However, note that upon exam, if our clients are ever examined, the very first IDR they're going to get says, hey, give us your wallet addresses. They then scan the input and output transactions of those addresses. And they say, now correlate these input and output transactions to your trial balance, or in our client's case, to your tax return. They're expecting that that's a transaction. So if our clients are moving things between wallets, probably too advanced, but if they are, we need to make sure that they remember and have some level of documentation. They control both, which is not a taxable event. Do report on the forms if you're receiving it for services, participating in mining directly or through a pool, a barter transaction, barter meaning property for services. If you're giving Bitcoin to your plumber, that may trigger gain or loss. It will trigger gain or loss because why? You bought Bitcoin at one price, it's going to be valued at another price. You're triggering gain or loss when you use it. So that's an important component of what we're doing. Exchanging one digital asset for another happens all the time. People diversifying. If you're staking and receiving it as a reward, well, the jury's out on this, and there'll be litigation from a couple of taxpayers. At the moment, staking rewards, most people report as income. So that's important to us. The other thing to report is if our clients happen to have an account outside the US that holds crypto and fiat or a stable coin, which is usually the case. And so that would probably require an FBAR reporting requirement. That's what most would say to do. And the checkbox on the 1040 has now evolved, which says now in 2022, did you receive it as award for payment for property or services, or sell, exchange, gift, otherwise dispose of a digital asset? So all the stuff that we talk about above, triggering gain or loss, yes or no. And so this is on the form. It has changed over time, and that's where we are today. Okay. What might we see from our clients? Notice I say exchanges may issue taxpayers. Okay, not all do this. So just because our clients don't get a 1099 doesn't mean we don't report it. Some exchanges take the position they don't need to issue 1099s. That does not absolve our clients of the requirement to report digital asset transactions. So the three that are most common are the MISC, the K, and the B. The MISC are commonly being issued for staking rewards, forks, or airdrops. 2022 had very few forks and airdrops, but it may happen. And so just be aware of that. Or a client may come to you and say, hey, I haven't filed my returns in a few years. And going back over time, we have had a number of forks and airdrops, which would trigger a taxable event. So watch for that. And the K and the B is usually used for sales of exchanges, those exchanges that you're tracking, facilitating clients, diversifying digital assets, buying and selling, trading. That's what that's going to be. So just know that forms may be created or issued, but they're not going to be 100% of the time. So self-reporting is important. Okay, in Lacerte, what are we talking about? Screen 17.1, Mini tells me is the right screen to use to put the stuff in. That is going to move the data between Form 8949, which is the detail, Schedule D, which is then the summary, and Schedule 1. There are questions sometimes around character of digital assets. Is it capital versus ordinary? I think most of our clients are going to have digital assets used in a capital capacity. They're investing in it, or not used in a trader business. If it happens that they're using it in their trader business, we should talk. So let's assume capital for now. Know that there are varied situations that may not be the case. Okay, basis tracking is a thing. This is complicated. Why? Because most digital assets, but for NFTs, are fungible. Okay, that means that we have digital assets that our clients have because they earned them, they bought them, they received them, whatever it is. And if you earn a digital asset and it's worth $100, then you pick up $100 of income. Let's say that I earned a Bitcoin, and just say for fun it was $100. Pick it up in income. And then I use it to pay the plumber in my example, and it was worth $120. Well, guess what? When I use that Bitcoin, I triggered $20 of gain because I've realized $20 of benefit and gain there. So But what happens if I earn one Bitcoin at 100 and one at 105 and 110? Well, since these are fungible, I need a mechanism to say which Bitcoin did I use. And so the picture that I've drawn here, and this is really more for businesses, but applies to anybody, is about keeping a wallet structure. Now, not all of our clients are going to do this. I would say most of our clients are not going to do this. But in order to feel good about choosing one Bitcoin versus another, which in my example would dictate the amount of gain I realize, I would need to segregate my Bitcoin. That which is fungible, most say you need to segregate it into different receptacles, in this case, wallets, to be able to choose the Bitcoin with 100, 105, or $110 basis. The FAQs 38, 39, and 40, I think those are still the numbers, do give us some instruction here. There may be some leeway if you're using a custodian and you're giving them instructions of which ones to use, but more often than not, if you don't want to use FIFO and you want to use specific ID, you need to segregate those. And that's why we have the picture listed here. FIFO is used commonly. That's not an incorrect accounting method. And if you don't segregate or have intention behind the digital asset you're using, you would be deemed to use FIFO. And so in my example, if I earned one Bitcoin at 100 and then 105 and 110, and I used one for the plumber worth 120, I would default for the one at 100. If I wanted to reduce my gain in that example, and I had the ability just to choose the $110 Bitcoin, I'd only have $10 of gain in my example. So that's kind of the way the rules work. There in the infrastructure bill, I have this reg cited here. The infrastructure bill was very articulate in citing covered securities in the way that they enacted that legislation, which is a very specific term under 6045-1D, which does enable us, it gives us maybe a hint as to where they're going with the treasury regs for crypto, which says providing some instructions to a custodian, a third-party custodian, may enable you to choose Bitcoin 1, 2, or 3 in my example. Yet to be determined, but wanted to be complete as we go through this. So safe to say for our clients, unless they go through some extraordinary means to segregate their digital assets, we would go on a FIFO basis. And that means we need to get through some basis calcs. And then depending upon the volume, you may need to like build some analysis or a spreadsheet. Yet to be determined how much that is really going to be. Okay. The topic of last year that's really tricky is losses. We had a lot of turbulence last year from a pricing perspective. We had failed protocols, failed assets. We also had bankruptcies. And I don't know how much this is going to apply to our clients, but if it comes up, please consult, grab me, grab Minnie, grab somebody on the team so we can spend the right amount of time. Clients are going to want to say, hey, I no longer have this asset that was in that custodian that's now in bankruptcy. This is going to happen. So what can we do with that? Unfortunately, not a lot. The guidance that we have historically, going back to the Madoff days, was put forward in this Rev Ruling and Rev Proc specifically for that fact pattern. And it was designed very, very narrowly. And so right now, at the date of this publication, this may change. The IRS has not given us range to take deductions, even if somebody feels like their stuff was stolen. There's a lot out there in social media about bad actors and CEOs of these exchanges and custodians that took their crypto and committed fraud. There's even the word Ponzi scheme used. Please be careful. The way that the IRS has defined fraud and Ponzi scheme in the Rev Proc and Rev Ruling was very specific to a situation, and it is yet to be determined whether or not that situation applies to the events of 2022. So if our clients feel like they want to take a position, or they feel like they were, harmed or something was stolen, then, we can deal with that. But I think we need to coach them on the front end. Hey, this is hard. Let's be thoughtful. And we may not have the authoritative guidance to take a position on the return just yet. That may change. Yet to be determined. But as of today, right, which is early February 23, doesn't feel great. Now, if they did abandon something, we might have a position, right? If they got rid of it, or if they sold their position. Some clients, some companies or individuals have money that's stuck in a bankrupt exchange. And they may say, okay, I have this right to it, but I don't know what I'm going to get in bankruptcy. And I'm going to sell that thing, that right to receive, for 10 cents on the dollar. Well, maybe then you do have a loss, right? And so it really depends on the facts and circumstances, and we'll go through it together as a team. Okay, that was a lot. There's going to be questions that come out. I only do crypto, just to be clear. I'm all crypto all the time, and this is all I do. And there's a big team that I work with that does this. And I would like to use myself and our resources to help answer client questions in this if it arises. And again, I'm proud of TaxAid's ability to help people across the board in this space. Please reach out to admin at TaxAid. They can refunnel the question. You can reach out to me directly, but do check out the IRS website. The FAQs are rather instructive. Know that that's not super authoritative guidance. And so please be careful of the facts and circumstances. Let's consult, to reach out to me and put me to work, and be proud, importantly, be proud of what we do in this space, serving clients of all needs, importantly, crypto. Thanks again for having me, Minnie.
Great. Thank you, Rob. That was so helpful. Yeah, so if you do have any further questions, please email us, and we will get the question to the right person, which is Rob and team. So thank you again, Rob, for your help today and sharing all this great information with us.
Thank you, Minnie. Take care.
All right. Thank you.